Hi, this is Nick Katko from BMA, and welcome to today's webinar, which is, hold on one second, folks, which is pricing and quoting for lean organizations. I'm excited about this webinar for a few reasons. Number one, this is a topic that is always one of the main topics in our lean accounting community chat. And also excited to have Ed Grindy here, who I worked with in the past when he was a controller at a very well-known lean company, and he has a lot of expertise in pricing and quoting, and he is going to basically do the first half of the webinar. So first, have a few things administratively. And you can type in the question pane. Can you hear me? Can you see me? And can you see the presentation screen? And just say yes, yes, yes if that's the case. If it's no, please let me know. So if someone can please answer that. Yes, okay. Very good. That's good. All righty. Thanks for that. So let's move on. So if you want a download of today's presentation on your control panel, if you click in the handouts, you'll see a copy of the presentation. If you are listening to this presentation via a recording, you'll have to email me and I'll be glad to send you the presentation. If you are a certified public accountant, this webinar, you are eligible to receive one free CPE credit. There are three things you must do. You must answer the 3 polling questions. You must be logged in for 50 minutes. You must attend a live event and go to webinar. We'll keep track of all that. At the end of the webinar, if you want a CPE certificate, just send me an email and I'll prepare it and send it out for you. And I'll remind you again at the end of the webinar. So what are we going to learn today? First, we're going to understand why is a lean quoting process necessary in a lean organization. Then we're going to talk about the steps to create a lean quoting process. Third, especially in companies that use standard costing, there's a paradigm that we need the standard cost to calculate a price. And by golly, if we don't have a standard cost, how are we going to calculate our prices? Well, we're going to show you a few methods of how you can calculate a price without using a standard cost. And another reason why product costs are needed is, what's the profitability of a possible sales opportunity? So again, we're going to show you some ways how you can analyze that profitability without using a standard cost. All right, so I have to do a little administrative thing here, and I am going to turn the presentation over to Ed. And Ed, I've given you the keyboard.
Okay.
And it is all yours.
All righty. Hi, everybody. I'm going to talk a little bit about this lean quoting process that was developed at Watlow. The whole process really is designed to move about 95% or more of your quotes quickly, where you just look at a handful of filters and they quickly quote it. And this saves time for all the people involved for the handful of large and special opportunities, special quotes that are really going to drive the business growth at what we call the Opportunity Review Board. First, we're going to look at the current state of a standard costing system. Then we'll look at the future state. Then we'll look at a few of the filters that are involved, and finally we'll get into the Opportunity Review Board, because that's the kind of the the growth engine of this whole process. Okay, current state quoting, really in your current, most companies, it's a silo type process. You have a handful of people that do the quoting. They don't get the manufacturing involved. They don't get marketing involved. They just basically are given a few tools and say, here, start quoting some of this business. And really the quoting in this scenario is all about just getting the business. There's no concern about the capacity in the manufacturing or in the front end. It's just always assumed unlimited capacity, and we know that's not always the case. They also do cost plus pricing. That doesn't take into account the value for the customers. It's usually what's the material labor overhead times a 3 markup, 4 markup, whatever your company has. And you don't know at that point whether the customer really views there's a value for you as a supplier, or do they just view it as a commodity. So when you do cost plus pricing, you're going to either give away money because you've got value that you should be able to get more for the product, or you're going to lose business that maybe you would help the value stream, but it's a little bit below your normal markup. And then they're usually fairly complex costing issues. You've got standard costing, keeping all that up, all the different overhead rates and labor rates. You're running it through an MRP system. You're probably creating bills of material that either stay out there or you have to take them out of the system when you're done. And the company I was at where we developed this, when we gathered the quoters together, there was 80 plus different tools that they were using. So depending on which quoter you got, what tools they were using, what cost centers they were running it through, you could get unknown number of different costs or prices for these products, and you just didn't know. Depending on the quoter, you could get a wide variety of prices. So there wasn't any consistency there. So now, in the future state, what we want to have is, one, we want to have a consideration of flow in there. That we want to make sure these quotes flow through the product, through the value stream much quicker. And as we all know, the more quotes you can get out, the more business you're going to get. Even if you don't change anything else, if you can get more quotes out, you're going to hit more of the business. We want them to take into consideration capacity, both of the front end and the manufacturing. It's very important to understand this, because if you're going to burden, say, your manufacturing area, and you've got to now buy a new expensive piece of equipment, you want to understand that. Same thing with if you're going to overburden your engineering staff, you want to know, am I going to have to hire somebody? Understanding value at the market price. That's just what it is. We want to know, are they coming to us as a commodity? That's all they view it as. And so you're going to have to get down and dirty on your pricing, or do they actually value what we bring to the table, and we can get more profit from that by just understanding that. Then finally, we want to come up with a simplified business decision-making model. As we said, we're not going to use labor and overhead rates. Where I was at, we actually got rid of the labor and overhead rates completely, and the routers and everything out of the business system. We want to have quick, easy to understand filters for the key decision-making points. We want to get total team buy-in on these opportunities. We don't want a quoter to just take on something that we're not sure whether or not the whole value stream can actually even do. And then finally, at the end of the day, we should see double-digit improvement in lean operating profit. Where I came from, we saw a 15 percentage point increase, and we saw our sales increase 15% the first year and 25% the next year as we got better at this. So it definitely is a way of increasing your sales and your profits. Now, at a very high level, this is our lean quoting process steps. You can see you've got first is the quote is received, then you run it through these filters that we're going to talk about in a minute here. If it passes all the filters, you can see down here, it just goes straight to, we either quote or no quote, and we send the quote out. And we should have most of our business go through that. But if it fails any of these filters, then we come up here to this opportunity review, which is a daily meeting. It shouldn't last any more than 15, 20 minutes each day, but it should include all your different functions. It should include, your manufacturing people, some of your quoters, obviously, your engineering staff, marketing, value stream leaders, and we like to see, and your accountant, and we like to see like a general manager show up once in a while, or even another value stream leader, and continuous improvement person that can also keep a track and make sure we're working this properly. And so then at the end of the day, what we do is we do a big in-depth review on these handful of important and large opportunities. We assign actions, we follow up on the actions, we review the impact to the value stream P&L, and then we just try to understand where it failed on the filter and what we can do possibly in the future if this is business we like. How do we keep track of that? So we'll get into that here in a minute. And so again, we're trying to get 95% of these going through where they pass all the filters that we've set up. And if you have too many coming through to the opportunity review, you probably want to look at your filters because you probably got them clamped down too tight. Okay, that should be the last one. So first thing we want to look at is the product reliability. Is this something that we're concerned about, that there's going to be a liability or warranty concern? Next, we want to understand the manufacturing capacity. Do we have the capacity to get this done? And or is there a constraint? Because that will have a big impact on our decisions, because when we get to the financial review board, you'll see where we use that to understand the impact. Technical capacity, same thing. You've got your engineering staff or your product design people. It doesn't do us any good to have manufacturing capacity if we can't get it out the door to the customer in time to the design and have them review it. So we need to understand whether or not there's the capacity there. Manufacturing capability. This really comes into, can we do it? Do we have the expertise? Do we have the equipment to do this? And we have a filter for that also that we'll talk about, and that it's kind of red, green, and yellow filter on what we can or can't do. Then price. This is one where you have a preset dollar limit that you've decided, if I get over this dollar limit, regardless of all the other filters, it's big enough that we know it's going to have an impact to the value stream, and we want to run it through the opportunity review to make sure we think it's a good thing. And then at the end of the day, we have our group discussion on a daily basis. And these larger, not only do we send the smaller quotes through quicker because of these filters, by beating daily, these bigger opportunities don't sit around on somebody's desk for a long period of time. You're constantly every day talking about it and assigning action items. And so even the large ones move through quicker than they used to. Okay, now here's the capability filter. That's don't worry about the size of that. In my book, it'll be a little bit bigger, but what we have here is we have this is for one value stream. We've got different product lines involved here. We have different series within the product line. And then we'll have down here, we'll have all the different options or that you may be able to want in this product line. And you can see we've got red, yellow, and green. And those basically are telling us if a customer comes to us and asks for, in this case, we'll say product line 1, this other option here, and it's a different alloy, that alloy number 2, and it's red. We'll just have to tell them, sorry, that's not within our capabilities. The yellow means we can do it, but there's either a manufacturing concern that we have with it, or maybe we just don't do it that often, and so we know it's going to cause a little bit of problem when we get it, but we can do it. And green is, yes, we do these every day. There's nothing really we have to worry about, so we know this one's a good one to go after. Material content filter. This one is an interesting one. This one is really the most controversial and generates the most emotional conflict, because this is what we're replacing material, labor, and overhead and markups with. The one thing we do know in a lean environment is that material is probably the only big variable cost that there is out there. As we free up manpower and overhead, that becomes free. So outside material and commissions, if you pay commissions to outside salespeople, this is the key one. And so what we do then is we create these matrices, and this is a case of value stream 1. We've got our different product classes. You'll notice we also have complexity levels, high, medium, and low, and then we have different volume designations for the different product classes. So this would be your lowest, your next lowest, the next highest, and then this would be your highest. And so again, if it's product class 1, medium complexity and low volume, it would be over here, and that would be the percent we would say if our material content to the sales price is below that, we take the business. If it's above it, we would then quote it according to hitting that material content percent. Now, the key here is that you do have a target price. A lot of times you'll have, especially when you first start this off, everybody will say, well, I don't know what the customer wants. The customer didn't tell me that. You go ahead and you generate your price to them, you send it to them, and they come back and say, oh, that's way too high. Well, they had an idea of what the target price was. They just didn't want to say it. They didn't feel comfortable saying it. As you get used to this process, they will start saying, well, it's going to be in this range. And if they don't come up with it, then you just do the simple math of taking your material content, dividing it by the reciprocal of the material content percentage, and that becomes then your target price. And again, the way you set that up is you get some IT people together and your manufacturing people together, and you just go through and you do analysis on it of where you've been successful before, and you decide where you want that filter to be at, where you're comfortable taking it automatically. So again, it's the hardest emotional hurdle to overcome. We don't take into account labor and overhead and everything. This is just like all the other filters. It's a no-go filter. So again, we try to move it through the quoting process as fast as possible. So then finally, you've got all these filters. We had one or two others that we didn't get into, but you have these filters in place, and they'll change by value stream, and they might even change by the type of business you're in. If it fails any of these filters, then it goes to what we call the opportunity review process. So again, it can lack, if you lack capacity, capability, or the opportunity is too big, it's going to come to this process. Okay, what this is a daily meeting that should last 15 to 20 minutes once you get going with it, and you should have a full cross-functional team there. You should have an operator in there. You should have a team leader, your value stream leaders. You should have your quoters in there, marketing people, accounting. A good cross-section of your value stream, because it's not only is it good that they bring things to the table that the quoters maybe didn't think of, it's also a good cross-training tool for the rest of the people to understand the business better. Okay, Nick, it's not wanting to move forward. There we go. So we also want to have a visual status of what's going on. So we'll talk in a minute here about the boards. There will be 4 boards out there. And so this will keep track of what we're quoting, what we have quoted, the opportunity review or the financial review board, and any gaps that we have. Flow, we want to have the flow. Again, that's a daily meeting. We update the progress, make decisions, assign new action items, and then we follow up on those action items. Initially, what's going to happen is the team leader or the value stream leader is going to do most of the talking, and it's up to the value stream leader to pull those other participants into the discussion. And eventually, anybody at the meeting should be able to run the meeting, but it takes time. And then finally, the overarching process here is we want to identify gaps that we have in the system, figure out how we can eliminate them, and then determine whether or not to quote them or not to quote them. Now here's the visual management boards. These are the 4 key boards that you would have up there. You could have more, but I would recommend trying to stay with these 4. You've got the current opportunities board. We'll look at an example here in a minute. That's where you keep track of everything, every large quote that failed one of the filters. We keep those on there until we make the decision either to quote or to not quote, along with the data involved in them. We've got the capability gap board. Here again, we want to keep track of this, of what we've passed because we didn't have the capability. And if you have value stream assessments, whether annual, semi-annual, this is where you're going to get the information to make some decisions then on what, if I want, do I want to go after that capability? Do I want to change my value stream to be able to make this? Now you'll have real data to work with and real sales numbers to look at to say, here's how much opportunity, here's how much sales we've lost because we didn't have this capacity or capability. Key opportunities quoted status board. That's when you finally do quote something and you actually send it to the customer. You want to keep that in front of you until the customer either accepts it or rejects it. So you keep track of that. Doesn't have near the data on it as it does for the current opportunities, but you do want to keep it visible until the decision is made. And then finally, you should have a financial impact board up there that you can look at the impact of these bigger decisions. Not every opportunity will go up on this because some of them won't be financially driven, but if they're any size at all, they will come up on here, or if it drives additional costs. Now here's a real example of an opportunity review board. There's several pieces of paper on here. This one here, that is going to be our standard work of how it works. Next one, that's our decision-making hierarchy. So we have dollar limits that we set the different employees that are working the process. They are allowed to up to a certain dollar limit to make these decisions to accept or not accept. And so, you know, everybody knows what their responsibilities are and at what level they can make these decisions. And we try to push that down as far as we can to save the time of at the opportunity review board. Then in this particular case, instead of having a separate capability gap board, we just put it right on the opportunity review board. So again, you've got some variance here you can do as far as how you set these up, but we put it right at the board so they didn't have a second board. And then finally, we have, this is all the data. Each one of these rows is an opportunity, and we have things in here like we'll have the date the quote was in, who is the customer, what's the size of the opportunity, a brief description of the opportunity, who the quoter was, what the next step is, the due date, and then finally the final decision. And so the due date is the due date for the next step. So you know then when that person knows what that next step is and when it's due, and then they'll be held accountable to be ready for it. And again, starting off, they will struggle a little bit with that, but eventually they learn the importance of having that data done and on a timely basis. And like I said here, this is where the fun happens. It really becomes at first it's kind of like pulling teeth because they're uncomfortable actually talking to people, but after you start getting used to it and they find out people don't die or from this process, they find out it's pretty good and it's enjoyable. Okay. All right, now this is I do not recommend using spreadsheets, and we talk about that on at the end here, but just for ease of reading, this is what it would look like, your decision board. Here we've got the key components at a very high level. You know, we don't worry about all the detail in there, because the more you dive into the details, the closer you get to standard costing. But what we have here is we have the current, either this is the previous 12-month rolling average of your value stream costs or the forecast going forward. But it basically says this is where you're at with this kind of operating profit. You put in these colored squares here the different costs that are going to be involved, but only if it really is going to impact it. You know, you wouldn't put in a half a person, say. The only time you put manpower in there on wages, fringes, and contract labor would be if you're actually going to hire somebody. You don't put in a half a person or a quarter person. So the key here is your material, the sales volume up here, your material content, and then if any true incremental costs, like in this case, we said there's some tooling that was required, 2,000 tooling. And so it comes down here and it adds it up and says what the impact of taking this job is going to be. Even though the material content is higher, it's it actually showing a better operating profit when you look at it from a lean perspective or from an incremental cost perspective, which then says it's actually, even though maybe standard cost might say it's not as good, it's going to actually help out the value stream. And so again, we really want to look at the overall impact in real numbers. Now here's a real financial hurdle review board. We call it here, we call it a hurdle review board, but it's a financial impact board. Here's some standard work over here, but you can see here we just deal with sales, commissions, material, conversion labor, conversion overhead, support labor, support overhead, and we just keep it in the big buckets. These are our annual numbers, and Nick will talk a little bit about hurdle rate, I believe, but we also have a hurdle rate down here and that's basically what we want the value stream to get to. And so we have our 4 different value streams here. Then we also have this is the additional costs of things that don't, whoop, gotta go back. How do I go back, Nick? Page up. There we go. This is the financial, or the cost of non-value stream costs that are in the plant, like your general manager, your controller, people like that. And then this is going to be the whole value stream P&L, or plant P&L. And so then the reason why you have all these different looks is because for one value stream, maybe the business isn't what we expect it to be, but it may help the plant, or it may even help the company as a whole. So you want to hold that up to that and see if that works. Okay, so implementation tips. First of all, you have to get your total leadership involvement and commitment. This process cannot be something that we do today, we don't do tomorrow, or somebody comes in today, doesn't come in tomorrow. So you've got to have entire involvement and commitment from the leadership team. Okay, this one is really important. The entire value stream also has to be involved in this process. You can't have engineering not showing up or marketing not showing up or accounting. It can't just be the value stream leader and his production people. It has to be all the different process, all the different functions involved. Okay. Can you move that forward, Nick, or?
Yeah, I can do it here. Hold on.
Okay, yeah, you just knock them forward because for whatever reason, mine isn't working here. We also want to understand the product strategy. In other words, what markets are we going to? Where do we add value? Where are we just a commodity? What customers do we want to go after? And maybe we want to get out of a market. So the quoters need to understand that. Understanding capacity, obviously, both where we have excess because we may want to get more aggressive there, and then the bottlenecks where we may want to really tighten up the process that we go through and start charging a little more. So if we do get it, we can afford it. Keep it simple and visual. This is really important. Avoid spreadsheets. Nothing's worse than going to a meeting and having a person having to pull up their computer, pull things up and show it up on a screen. It really makes things tough for them. Requires daily meeting, of course, same time, standard work. We have to have that happen. And then finally, I guess that's not finally, but next to last is process is a learning opportunity. So this really builds the knowledge base of the whole value stream, so people start making better and better decisions because they see basically how the sausage is made. They understand what's going on in the value stream. And then obviously you want to keep the meeting moving. You don't want to have it be too drag out very long. It's best to have it stand up, not sitting. You sit, you tend to have side conversations. So you've got to have it as a stand, or should have it as a stand-up meeting, and obviously just make it data-driven decisions. Don't let people override it with emotions.
All right. Thanks, Ed. I'm going to take over the presentation, and we'll bring back Ed at the end for any questions and for the wrap-up. So the first thing we have to do is answer our first polling question. I'm trying to find my mouse. So here, the first polling question. All right, so the purpose of a lean quoting process, select one of the following. It's to flow simple quotes very fast, solve complex quotes faster using a daily meeting, drive revenue growth, or all of the above. I'll give you about a minute or so to answer, and if you want CPE credit, please make sure you answer. All right, looks like a few more people are voting. About half of you have voted, according to my little control panel. All right, I'm going to close it and share the results. So, all of the answers are correct, but the correct answer is all of the above. So I am going to close that poll and move on. Can you see my screen, Ed?
Yes.
Okay. All right. So let's talk about analyzing product profitability. And so this part of the webinar is going to be more about sort of tools and practices that you can use within a lean quoting process. Ed touched on some of these practices, and I'm going to go into maybe a little more detail and show you a few simple examples. So when you're looking at understanding the profitability of a product, whether you're trying to set a price or do a quote, what is the price that the customer will pay? Okay, that's one thing sometimes we know, sometimes we don't know. Then there is what I call the desired price. Ed mentioned this earlier. What is the target price? How much would we as a business like to charge to make the kind of money we want to make? That's the idea behind, this is calculating some sort of a price. Then the third piece is whatever opportunity we're looking at, how profitable is this? Because the fact of the matter is, in many cases, the price the customer wants to pay is not exactly what you would like to charge. And so, you get into this issue of how profitable is it? When we look at price, it, it is common knowledge that the market or the customer sets the price. In fact, whenever you talk to anybody, that's what they say. Who sets the price? The market does. One question to always ask when you're in this, because a lot of people want to understand, what should calculate a price. You can sort of almost turn this around back on the people in sales and marketing and say, what is the highest price the customer will pay? And, that gets into the idea, and Ed mentioned this, sales and marketing people typically have an idea of what the customer will pay. And that's why they may, or sometimes they don't, but most of the time they do. And, organizations talk a lot about price, but one of the unique aspects of a lean organization, if you're familiar with lean principles, principle number one is value. And really what you want to do in a lean strategy is compete on value. And then you can get the prices you want. So what does that mean, compete on value? Well, you, as opposed to thinking about lean just about improvement, lean is really about improving to create a competitive advantage for your organization in the marketplace. Now, I learned this in the 1990s as a CFO. I didn't know much about lean. And in the space of a couple of years, we reduced our lead times from over 20 days down to 3 days. Our on-time delivery went from in the 60% range to over 95%. We also, by the way, reduced our inventory, but just reducing the lead time and improving on-time delivery, we started outperforming the competition, and our sales, which this was a 75-year-old company, which averaged about 5 or 7% growth a year, all of a sudden we're selling at 20% a year, and we had the highest prices in the industry. And that was one lesson I learned. So, talk about value. Okay, price is a whole lot easier when you are performing and delivering the value that you want, that the customers want. Now, when it comes to cost plus pricing, and you hear it often, and maybe even in your organization, well, we need to know the cost so we can set the price or calculate a price, which is really a desired price. Well, one of the faults or weaknesses of cost plus pricing is that this idea of a product cost being needed, the product cost is not accurate. And for two primary reasons. Number one, when you get into the labor and the overhead setting, that really is an arbitrary allocation of fixed costs. And the other factor is that a product cost in a standard costing system is primarily driven by how long it takes to make the product. But how long it takes to make a product does not change the costs of the company. I mean, simple example, if you made two products, product A and product B, product A took 20 minutes to make, product B took 30 minutes to make. So today on Thursday, you're making all product A's, and you have, 30 people in your value stream. Tomorrow you make all product B's. Those 30 people still come in to work tomorrow and they're getting paid the same amount of money. Your costs haven't changed. And so we want to get away from cost plus pricing. So how do we calculate a desired price? Here's two simple methods. There could be other ones out there, but these are the two that I think are simple and easy and can be used consistently. One is the hurdle rate, where you're looking at a contribution margin percentage. Another one is sort of a derivation of a hurdle rate, where you're looking at contribution per minute. So let me give you some examples. So to calculate a contribution margin hurdle rate, start with either your annual budget, a 12-month forecast, or you can even use your current P&L. So you look at your P&L a little bit differently. What are the sales? You want to subtract the variable costs. And really in manufacturing, the only true variable cost is material. You calculate an overall contribution margin. You subtract out your fixed costs and you get to a profit. So what you do is you calculate fixed costs as a percentage of sales, and then you have to determine what is your desired profit percentage. So if in our financial plan, for example, we want a 15% profit before tax or 15% operating profit, that's this idea of a desired profit percentage. So your hurdle rate is pretty simple. You take that desired profit percentage, then you add to it fixed costs as a percentage of sales, and there's your hurdle rate. Now, how do you use the hurdle rate to calculate a desired price? You take your actual variable cost per unit. So you're looking at a sales opportunity. You can get to the actual material cost per unit, and you divide it by the reciprocal of the hurdle rate. Let me show you an example. Here we have a value stream, and this is a budget. It's very simple to calculate the hurdle rates. Hurdle rate's 57%. We have a 35% desired value stream profit rate, add into the fixed cost percentage, 57%. So how do we use that to calculate a desired price? So let's say that the material cost is $17 per unit. Our desired price would be $39.53, which is the $17 divided by the reciprocal of the hurdle rate. So we can't go into a discussion here because we don't have time. What about if the customer only wanted to pay $38? Is this a good opportunity? Would you accept $38, and under what conditions? So let me throw out some ideas here. So first of all, $38, it's still profitable. How profitable? Well, it depends on some factors. What is the volume of this order, and how does that impact capacity? What's the time frame? Is this a one-time order, or is this going to be a continuous order? And from a strategic standpoint, what about this customer? Or what about this opportunity? Is this like a new customer in a new market or something? And I'm going to show you some examples of calculating the profitability. But first, let me show you the contribution per minute. So again, we use our 12-month budget or annual forecast, or updated forecast, sorry, and we get to a contribution margin. But what we do here is we divide the contribution margin by the planned volume in units multiplied by the cycle time. And we get a target contribution per minute. So this is a rate per minute that we want to get. The next step is to determine the average cycle time of the bottleneck process. In lean, in operations, there always is a bottleneck process. And the bottleneck process is simply the production operation that has the longest cycle time, because that determines the rate of flow for the entire value stream. The next step is, if we're looking at an opportunity, look at that specific product and calculate its actual cycle time through the bottleneck, because there's always a little bit of variation. And then the calculation to get to the desired price is, what's the target contribution per minute multiplied by the actual cycle time, and then we add in any variable costs per unit, and if we want to mark up those costs, we can to get a price. Let me show you an example. So here we have the same value stream income statement, but here's our annual volume and our average bottleneck cycle time. And if you divide the contribution margin by the annual volume multiplied by the cycle time, you get a contribution per minute of $2.05 per minute. So if we're looking at this opportunity, so it's a $17 material cost, but this product has a cycle time of 12 minutes, not the average of 10, so it's a little bit longer. So what would the desired price be? It would be the cycle time multiplied by the contribution per minute plus the variable cost gives us $41.60. That is the price that we would, if we could charge that price, then we would be making $2.05 a unit, or $2.05 a minute. Now, again, if the customer only wants to pay 38, then we have those same questions we have to answer. So the hurdle rate is really, really good. It's simple. The contribution per minute gives you a little bit of variability on what's really going on in operations. So before I go on, let's open up poll number 2. So which of the following statements is not true? That companies set prices and charge customers accordingly, that product costs are not accurate, prices determined by customers based on value, and that cost and price are not related. Okay, I'll give you about 15 more seconds. All right, I'm gonna close the poll, share the results. So yes, companies set prices and charge customers accordingly. That is the correct answer, and most of you got that correct. All right, so let's move on. So how do you calculate the profitability of these sales opportunities? Well, you need certain information. You need price, volume, and time frame. Meaning, is this a one-time order or a continuous order? You need to know the material costs and other variable costs. You need to know the available capacity in your value stream. And you need a current value stream income statement. And really the goal is to calculate a future state value stream income statement and see if the future state is better than the current state. Let me show you some simple examples. If the available capacity is greater than the volume, you calculate a contribution margin. Not the rate, but the actual dollar value, the contribution margin. You can do it per unit, or you can do it for the whole opportunity. Again, then use a future state value stream income statement, compare it to the current state. And if it's greater, you can accept. You always have to understand, are there other considerations? Here's a simple example. So here's a current state box score and a value stream income statement. And the opportunity, we were talking about this $38 opportunity. This is a volume of 1,500 units a month. The material cost is $17. It's very simple to calculate what the incremental profitability is of this order. And you can see it's $31,500 a month. And in the capacity, you can see how much capacity it is using. And you could calculate the future state capacity. Because we have 10% reserved already, our available capacity goes from 18.4% to 4.36%. Our profitability goes from 52,000 a month to over 83,000 a month. So this is a pretty good opportunity, even if it is a little bit below our target or desired price, because we have the available capacity. Now, if you don't have the available capacity, you need to calculate the cost of that additional capacity. Again, compare the future state value stream income statement to the current state and determine whether you accept the order or have to factor in other considerations. So here's a simple example. We have the same value stream income statement, the same box score. So in this case, the price is only $26.25 a month. The volume is pretty good, 1,250 units, but it's a one-time order. So you can see that the contribution margin is $12,313. Now that is more than the current return on sales, but that hasn't factored in capacity. You can see that we need about 10% productive capacity. If you look at the current state, we only have 8.79%. So this is where you have to think, now, what can we do? So there's lots of different options. I'm just going to show you one. So in this case, the company, because they reserved that 10% capacity, they decided, let's use that 10% capacity for this one-time order to boost our short-term profitability. Now, you wouldn't want to do that on a long-term basis, but if you didn't want to do the reserve, use the reserve capacity, another opportunity would be working overtime. Well, you could calculate what the overtime cost is and factor this in. Either way, you get to a future state value stream income statement. Now, the contribution margin is a little bit less, but the value stream profit is a little bit more. So our third polling question, I just need to find my mouse. There we go. So how is the profitability of a sales opportunity calculated in lean accounting? Using standard product margin, just increasing the profit before tax on the P&L, calculating a future state income statement, or it doesn't need to be calculated. All righty, looks like most of the people have answered, and the results. And everybody has been paying attention very well. Thanks a lot, appreciate it. All right, let's wrap things up. And Ed, you're back on, right?
Okay, you tell me.
Yeah. So, we talked about the necessity for a lean quoting process. Ultimately, we improve the flow of quoting, we can drive more revenue growth. We want to feed that value stream with as many orders as possible. We want to create flow. Simple quotes move fast, even complex quotes. This idea of the daily opportunity review is going to create flow, and those complex quotes will move faster. We understand that we want to look at contribution margin or contribution per minute to determine the desired prices. And analyzing profitability, it's about looking at a future state value stream income statement compared to the current state. Only consider the actual incremental costs and the impact on capacity. So there's some final reminders. Please complete the survey that you will get after this webinar. That helps us. As another final reminder, if you want CPE, send me an email and we'll get you the certificate. So Ed, why don't you talk a little bit about leveraging lean quoting?
Yeah, this is a book that I'm working on that hopefully it'll be out sometime in the third quarter. It goes into a lot more depth than what obviously we talked about today. It talks about why standard costing is not a good way to run it, the fallacies in the current state of standard costing, and it actually even gives you the opportunity, even if you are using standard costing, how you can use lean quoting to still use the process without impacting your standard costing. And so it gives descriptions of how to create these filters, how to run your opportunity review, all the participants that need to be there, why it even is necessary, what brought me to coming up with this process. And so anyways, it should be available before the end of the third quarter. And obviously my contact information is up there. Either one of those email accounts will work, and I'd be glad to answer anybody's questions that they can think of if they don't want to ask them today.
Yeah, and when the book is available or almost available, if you are on the BMA mailing list, you'll get some information about its availability. We're not going to sell it through BMA. It'll be on Amazon, but I'll send you a notification for that. So, you know, BMA learning opportunities. We have lots of content on our website. You know, you can join our mailing list for future event announcements. We have blogs, case study videos. All of our recorded webinars are available on the website, and also our lean accounting assessment. And this is how you can contact me. And if you haven't participated, we have a weekly lean accounting community chat Tuesdays at 11 o'clock. It's free to attend. We just like you to register, and that's the link to register. And there were a few questions. I was just looking at the questions. Some people had some problems voting. If you had a problem voting and it is related to you getting continuing education credits, send me an email. I actually see people, they voted in the question box, and I'll make sure you still get your CPE credit. And I just wanted to, there's an appendix here that I wanted Ed to just explain before we wrap things up.
Okay, there you go. Yeah, this is the opportunity review board that basically we have set up. You can see across the top, maybe you can't because it's pretty small, but that's all the different decision points and data points that we have in terms of the date the quote came in, the quote itself, the customer, and so on, going across here. Down below here, we have the standard work document. We list all the filters that are there, and also we may have the capability gap board here, or it may be a completely separate board. Now, here's the capability gaps. We've got what is the gap, the product type. I can't even read that. That's so small.
Series, customer date, and
yeah,
status.
There you go. And then additional status, yeah, and then additional comments. So that's just historical data. So when you do decide you want to that there's enough business in this certain capability, you've got some real data to work off of and decide whether it's worth the effort of buying more equipment or hiring more people or training your people up for it. That's the key opportunities quoted board. Again, this is for when we actually do quote it. You know, you've got when did we submit it, the customer name, what market was it in, the quote number, opportunity description, value stream owner of that quote, the follow-up date, whether we won or lost, and then any additional comments. And you keep that up as long as the quote is out there. Once it's quoted and it's done with, you take it off that board. You don't want to clutter it up with historical data like that.
All right, so that wraps things up. Everyone, thanks for attending. Ed, thank you very much for participating. It was enjoyable, and also I learned something, and I hope everyone else learned something. So everyone else, please have a good day. You have any questions, contact Ed, contact me. We'll be glad to answer your questions, and I look forward to seeing you at our next BMA event.